Republicans, they tend to be the drill baby drill crowd, right? They're going to unlock the floodgates and go for energy independence. You could see crazy sort of libertarian policies like an export ban come back. That would really screw with the global oil markets.
Hi everyone, welcome to another episode of World of Oil Derivatives. I'm Greg Newman, the Chief Executive of Onyx Capital Group. Today's podcast is an extension of our mini-series Onyx Leadership. Today I'm joined with Jonah Van Bourg, who is a new director in the business. He's been brought in to do some very exciting things. He's got a great plethora of experience in everything from crypto market making to oil trading in the physical world to banks, and there's loads and loads to discuss. Can't wait to get stuck into it. Thanks very much, Jonah, for joining.
Thank you for having me.
And just a quick reminder out there before we start, please like and subscribe. It really does help the channel. So Jonah, let's start. Maybe it's a little bit confusing when we told people about what you were doing here, but it's just quite convoluted, right? So maybe we could define it as like, at the moment, you're ultimately a director in the business, helping us, taking us to the next level, let's say. So obviously we've established ourselves as a liquidity provider in the institutional space, but as that evolves, and this is obviously what we can talk about, how do you take that to the next stage, liquidity providing? How do you give access to more than just the institutional space and all the kind of dynamics that are involved in that? But just before we do, you're a podcaster yourself, right?
Yeah, of course. Crypto.
What is your podcast name?
My podcast is called 1000X, spelled 1000X.
Nice.
And we talk about crypto for retail traders and retail investors.
It does very well. I think 1000X are views as well.
Tens of thousands of people seem to listen to it. I still can't really figure out why. It kind of just got started because one thing I've always done throughout my career is put out market commentary.
Yeah.
And in crypto, I think the attention span is fairly short. People don't like to read stuff, but if you post short little videos, you get attention. And the previous trading business that I ran was, a lot of retail people would trade with us. So it was a good way to generate some flow and get the word out.
And that's always been like, even before you were doing that?
Yeah, I mean, even when I was at Vitol and Goldman, I would publish notes about crude oil because I think writing is a super important part of trading, right? If you're trading prop or if you're market making or you're doing a bit of both.
It's a very unusual thing to say. I do agree, but why do you think that is?
Well, I mean, if you can't write your ideas down, if you can't just sit there and compose it into something that's digestible, then you don't really know what you're talking about. You're probably just taking risk on a whim, or probably your thesis that you have to cling to when you're losing money, which is the hardest thing to do. Like, it may not even be that well formed and you may not even believe in it. So I think if you just take a little bit of time to write down what your ideas are about the market, you find out pretty quickly whether you believe in yourself, whether you or whether you're just spinning bullshit that you don't believe in. So,
and then I guess it's good to then it's easy to get feedback.
Yeah, then you spark debate. Yeah. Then people who disagree with you are going to pull you out of your little echo chamber and tell you things that you haven't really thought about, or maybe make you think twice before doing something stupid. So it's a great way to foster dialogue. And in crypto, it's a Gen Z thing. I think more podcasting is just more the medium that people prefer.
Yeah, I see that point. Like how you communicate with retail and big enough markets, you're in it together almost kind of thing. But a market like oil, market in professional oil space, Goldman Sachs and Vitol, it's actually we don't really want to be educating our competition, is what people would usually say. But I've actually noticed the opposite. If you come out and say what you want to say, people will want to challenge it, and you end up actually, as you just say, you get the kind of same impact anyway, and it shouldn't really matter. Of course, some people abuse that, right? And say they say things that they don't actually think is true. Just
to shit post or get a little bit of, it's called engagement farming in crypto.
Engagement, okay.
I mean, I think that if you're running the type of business that thrives on opacity, like you have some unique information that nobody else has, you don't want to get the word out. And there's a lot of that in oil, frankly. There's a lot of that going on.
So let's start. I mean, you started off, your very first job, wasn't Goldman Sachs, it was Lehman's, right?
Lehman Brothers.
Yeah,
just bright-eyed, bushy-tailed, coming right out of college. And
I mean, you've literally been in the spaces, and I'm jumping ahead now, but it's just funny thinking about it. You've been in the spaces where all the maximum drama has been.
Yeah.
So you come in what year
2007.
Was it? So 2007. Yeah. Just before Lehman collapse. And,
July of 2007, Lehman stock hit a high. We were, people around me thought they were the princes of Wall Street, about to take the throne from Goldman Sachs.
And this was
the
bond
narrative.
trading.
I was a bond trader.
Okay.
Bonds and credit derivatives like CDS, credit default swaps.
So the big
during
one,
the
right?
Financial crisis. Yeah, it was the hot new product. We had a rotational analyst program, and I was, one of the more sought after first year analysts.
So that was seen as the top end thing.
That was seen as the top desk to do. It was the sexy product, and so I picked it over. Commodities was my second choice, and a few other things. And ultimately, what ended up happening was the biggest bankruptcy in American history. Didn't expect it, but you learn a lot when you sit on a trading floor that big. You get your intro to finance. You're introduced to 1,000 people, salespeople, managers, other traders, your boss, back office people, and you watch how they all interact towards each other and towards you when times are like amazing, great, good, so-so, bad, pear-shaped, bankruptcy, everyone out on the street, then like back to bad, so-so, good, great. And you see how they, you learn a lot about human nature and about markets.
Incredible experiences. But
good experience.
I've never asked you. So in layman's, it was all a high, right? Still when you joined.
Yeah, it was on the highs.
Yeah. No one was seeing this happening.
Billions of dollars were raining from the sky.
Yeah.
Nobody saw it happening. Everybody was getting really proud of themselves, buying houses in the Hamptons.
Leveraging up.
Levering up. It was a real boom, and credit derivatives was driving a lot of it. Like every day we'd come in and make markets, 100, 200 basis points wide on single name sort of credits that we could hedge 10, 20 basis points wide. So we're just back to backing stuff.
And who are you hedging that with? Just other banks?
Brokers, other banks, vibrant broker scene in New York City back in 2007.
So the arbitrage was between like the more professional space and institutional space.
That's right.
Okay.
That's right. So basically, if credit hedge funds and people with bonds to hedge would come in and trade with us, we would make stupidly wide markets. And then there was this sort of interbank broker market that was super tight. So we would just for some reason, the hedge funds couldn't talk directly to the brokers. There was some regulatory thing. Right, it was just arbitrage that was wide
a regulatory
open
arm
to the
almost.
Yeah, exactly.
Wow. So then you've talked before about the bond market in general being a market that, not only of course was very volatile, but also the way it developed. I guess that regulatory arbitrage did eventually go, right? And it
did. Yeah. So the CDS desks evaporated when the hedge funds could talk directly to brokers themselves. Also, a lot less CDS got traded after the financial crisis because that market became fraught with all sorts of other regulatory problems and scrutiny and blowback from just the broader public being upset about the bank bailout. But the reincarnation of that market is super tight, and the market that that underpins it all is the corporate bond market, and that's the classic example of a market tightening up. So in the 80s, you read books like Liar's Poker. Michael Lewis writes about these like big shot Lehman Brothers bond traders, or the I forget which one was in LA, driving their gold Ferraris around, and basically the way they were making all their money was just by exploiting an arbitrage between those who had access to transparency and liquidity and those who didn't, right? They would buy a bond for 80 cents on the dollar and sell it for 95 cents on the dollar in the same day, take no risk, because nobody else in the world knew that this bond was worth 87 cents on the dollar, right? And then Trace came along.
Right.
That's, you and I have talked about this. Trace was just it's like a ticker tape for bonds. One day it showed up, and all these guys, their spreads collapsed from 15% to a couple of basis points, and a very sad kind of nostalgic crew after that.
But I love that because this is going back 15 years ago for our story that we're telling today, I guess in a way through you, is that is the horse's mouth, how it was working. And I'm just going to label that like a market access thing. So again, if you just fast forward quickly all the way to what we're doing at Onyx, the market access for commodities now, or for energy trading, more so at the moment, that kind of thing. This is within already a professional space, how much money has been made just to get access to things, or in between access of things. Obviously, we've come a long way since then, a lot of asset classes, but there's still a long way to go for retail and institutions to get into this world if they so choose, and not get ripped off in general. And I just leave that there for later, but I just wanted to say that. And then so you just wanted to quickly touch on this as well. When everyone was printing money, and they were essentially doing this arbitrage, did they think they were really clever?
Yes.
And why did they think that? Did they think they were like proprietary trade, directionally trading, or?
Well, I mean, they did take some proprietary trading, sort of directional risk. But in general, one thing that I've noticed throughout my career, having watched success stories turn into failures and vice versa, when you're making money, I think it's human nature to want to believe your own myth, right? You want to believe that in your origin story about how you overcame the odds and did something special. And even if a lot of it happens to be luck or good timing, it's not human nature to just show up and say, hey, this windfall that I just earned for my company, some of which I took home, is blind luck or just good luck and hard work. People really love to believe their own myths. So there's a lot of hubris and ego on my trading floor at Lehman, and more broadly at the company as well, which led them to do some incredibly stupid stuff. Like, for example, two seats away from mine, was the financial bond trader, and his job was to literally spend Lehman's money bidding up Lehman bonds to make our credit look more appealing, so that customers and other counterparties during the financial crisis wouldn't pull their credit lines and walk away and cause us to go bankrupt. So
you start to get this feeling of invincibility.
That's right.
And I think all traders can be guilty of that at times. You just live different degrees. But I've just got to say, again, because we're talking about Lehman and then banks, it just makes me think I've got to give credit to my last boss, Alf, because he was at Morgan Stanley, Goldman Sachs, and he apparently was always doing curve arbitrage. And I think they used to speak disparagingly about that. Oh, you only make this and you only do this. But he knew exactly what he was doing, where the money was coming from. He didn't care. It's like, this is how I to trade. This is a reliable trading strategy, and I'm clever at doing this. But he wasn't saying, I'm some genius doing X, Y, Z. So he never fell for that. I don't know whether he learned that through experiences like yours, seeing it the way it can be and the way people can think, and thinking he doesn't buy in, or he was just like that. So then when he started Mandara, and we got involved, it was always underlying those principles. It was like, don't tell me I just have a feel for this, or I'm just, tell me precisely where you're making the money. And what's that's so good for is risk management, because no one's saying you can't take a chance on something, but how are you structuring your risk management? And it feels like that doesn't exist, or didn't exist in banks, doesn't exist in some oil companies that don't realize that such a big proportion of their money is coming from the system. And the way to define that is it flow from someone who's saying, look, I need your credit line, so I need to trade with the bank. Give me a price for jet fuel. And the bank says, yeah, sure, I'm going to give you a crap price because I need to cover the credit costs or the credit exposure. But then a trader says, let me take that margin and run some risk. They make money and they say, aren't I a genius?
Yeah.
But were you lifting the offer? Were you hitting the bid? No. So it must be so difficult in a way, because especially if you were a graduate coming into a bank, you work on a trading bank, work up through the levels, and then suddenly you got all this big risk. You probably don't know genuinely that a lot of your embedded edge is coming. You probably believe yourself that you're just a great trader.
You the answer is you don't. Now, when I was at Lehman Brothers, let's face it, I was a junior guy. I was only there for a year. And most of my job back then was answering the phone, booking trades, executing trades for people.
But you still thought you were king of the universe, right?
Not yet. That happened later. But basically what happened there was I really, really got humbled by that experience. It was brutal. Just when I was starting to come of age, the company went bankrupt, and all the people who were buying their real estate and levering up, you could hear them crying in the bathroom, and they were getting divorced and selling off assets. It was dark, a very scary, weird place. Very not the kind of experience that makes you think you're king of the world. However, at Goldman, unlike your former boss Alf, I did succumb to a bit of hubris and thinking that I was the king of the world when I was running the crude oil derivatives book there. I rose pretty quickly from the associate on the book to pretty much running it globally, quoting the biggest oil flows in the world.
And how did that work, by the way? So when you say you became a managing director, or it wasn't? How does it work?
I was just one level below that, and then
because they saw you as the best trader to do it, basically.
Yeah. I mean, I was good. I knew how to make markets tight and right. It wasn't that complicated. It was just I happened to be the kind of person who was good at building trading models.
You weren't under any illusions about what you were doing, though. You were just good at what you were doing.
Yeah, I was a good market maker. I was a terrible prop trader, good market maker, and I started to get a little bit distracted, and I started to think that I was just like, God's gift to trading. It happened towards the end. It happens to many people in their late 20s once they start to make some money and get a little bit of responsibility. I got a big head.
Okay, you're talking about getting a big head, but in terms of your actual trading, you were under no illusions about how you were making the money, though.
I was. So
Oh, okay.
I knew I was a good market maker, but I started to conflate trading with market making.
Okay.
It's not necessarily true. So I think where I got myself into trouble was I did indeed get very deep into the technicalities of making markets in options and exotics across this global, extraordinarily complex book filled with nonlinear derivatives and linear derivatives. Just every type of crude oil under the sun was getting thrown into this big book at Goldman. It was the beating heart of J. Aron, which was their commodities business. I was at the center of the action.
Wow.
Then, I started to think like, I'm just a good trader, not just I didn't have that like chip in my brain that said I'm a good market maker. I'm a good trader. And then when I eventually, Vitol poached me and I went over there, I really struggled in the beginning because I realized just how little I knew. And the lesson to take away from that for anyone who cares about oil is ask yourself daily, how would I make money if I left my seat? Like if I left my seat, if I had to go to another company, if I had to sit inside Millennium or one of these hedge funds where they're
You're
like,
just giving capital.
Here's a computer. It has Microsoft Windows installed on it. Go, right? Like no system, no flow. The phone doesn't ring.
Yeah.
Right. Like what did you do? Looking back on my time at Goldman, what I should have done is gotten deep into R or MATLAB, like predecessors to Python. Really understood the options models. Really understood the way the market moved based on the flows. Tried to quantify it and build things that would that would permeate outside of Goldman. And I didn't because I was, Mr. King of New York City for a few years and forgot about that.
But to be fair to yourself, I mean, like you say, trading is trading at the end of the day. And you may have a huge system. You still need someone, the best person to run that system. So I think the probably fairer thing is you're a great system trader.
Yep.
Which is not an easy thing to do. Like someone who prop trades in their garage or whatever, they might be very good, have a good return, but you're talking about, let's say 10 grand of capital. If I gave them $1 billion under management, say, can you handle that? And make sure you make 10%, and you might be getting flow here and there, but it's a lot to handle, right? I mean, that's a fair point.
It's a lot of work and a lot of
you called it something like, was it just big boy trading?
big book trading.
Big book trading. It's a thing,
trading.
Right?
Yeah, it's a thing. I mean, there are different types of big books. You can have a big prop book, or a big flow book, or a big physical book, which is essentially a market making book at its core.
And it requires a slightly different mentality. You've got to be able to handle the responsibility of that.
Yeah.
And when you make a change or you want to reverse your position, you're talking about moving
lot of
flow, hundreds of millions of dollars at a time.
Yeah. So I think that's what companies like Goldman and Vitol do well. They hire really, really talented big book traders, and
where do you become a big book trader? Like at a bank?
Yeah, Goldman's a good place.
Yeah,
I mean, you build a network, you understand the commodity, you're surrounded by people who can answer questions for you if you aren't sure about something. Where the pitfalls are is that when you spend too much time running a specific type of big book, the drivers of P&L in that book aren't necessarily the types of things that you can hear everybody on a commodities floor talking about, and so you start to discount other people's ideas. That's the risk. And what I mean by that, I'll give you a concrete example. If you're running a giant market making book and you're quoting Mexico and Egypt and Paul Tudor Jones and Amaranth and these giant companies, right? You start to think, hey, fundamentals don't matter, because when was the last time an EIA report actually impacted my P&L, or when was the last time some European storage metric that I hear the products geeks over in the corner talking about, like when was the last time that moved my P&L by enough to make a difference for me? And the answer is fundamentals do matter. They just don't matter to the P&L of a market making book. They matter to other little pieces of the oil market that maybe aren't focused on. So it's very easy to get distracted and discount things unnecessarily.
Yeah, I think, but the relationship with the fundamentals for me, I've never had a problem with people saying that it's important, but I have had a problem with people saying, like I was moaning on the chat yesterday, there's no supply and demand God. I would use that phrase. It's like, where did the fundamentals interact with the market? And it's hedging. If you hedge, it's a flow, it's derived to physical, it's really impacting the market.
Yes.
So people need to say the fundamentals moved the market with this hedging flow. I think the example yesterday was petchem hedging flow. Yeah, okay, that makes sense. That's a fundamental justification for a market moving. Yeah. But without that petchem flow, or the lack of petchem flow can even actually be, because if the market's used to having this flow and suddenly it doesn't exist, then the market can move.
Well, it's always flow. I couldn't agree with you more, but
I'm
it's
saying
always
that's the
flow.
relationships.
But it's not always derivatives flow. Perhaps I would say like when a tank is empty versus full, or when it goes from full to empty, that's a fundamental indicator changing. At the end of the day, that may not involve a derivatives transaction, but there is oil flowing out of that tank.
Yeah,
right?
then you need to piece how that gets into the derivative price.
Precisely.
And the way that it does that is through storage hedging, right? Or is through people trading it. But then I know what you're going to say, but it's the physical differential that is used to settle a benchmark. That is the impact of physical.
Yes.
So it's a third of the dated Brent benchmark, or sometimes even less, right? Depending on how things have been. So you can quantify these things. But I think this is a whole other podcast. But it's a debate that you kind of continue to have and dissect, but you can't make a sweeping statement like fundamentals don't matter, but you also can't make a sweeping statement like you can't trade derivatives without physical.
You're so right.
Yeah.
They go hand in hand.
Hand.
The whatever fundamentals, physical or otherwise, that we're talking about, it always flows through the derivatives market one way or another.
And no one would know better than you, being on both sides of the coin. So you did the Goldman's thing. You then made the pivot to Vitol into oil. So you were already trading oil, but derivatives, very exclusively derivatives, right? Yep. You hadn't traded any physical and been involved
Correct.
in physical. So what was that all about? What was the transition to Vitol about?
So interestingly enough, a lot of our bread and butter at Goldman was making markets on options too wide, right? And people would still trade with us because oil had just gone through this spectacular whipsaw during the financial crisis, where it went up to almost $150 a barrel and traded down into the, I forget where it was, 30s or 40s, whatever. So there was a lot of speculative interest in oil, and options offer good leverage. So people were really lighting us up, trading a lot of options. Mexico was hedging with this massive options deal, not particularly as efficiently as they do now. So there were inefficiencies. We could make more money out of it than people do today. But basically what happened around 2013 was, instead of, we'd get asked to quote up some teeny option. Somebody'd say, "Hey, Jonah, where's the Feb 14 $140 call? I'd have it worth 2 cents in my sheets, and instead of making it one bid at 3, I'd make it 2 bid at 25 and get lifted on large size." That was just easy money, right? Because who would sell a teeny? They're a hedge fund. They buy teenies. Teenies are low delta options. Anyway, flyers, lottery tickets. Then one day on screen, that market was one bid at 3 on infinite size. Just sort of came out of nowhere one day, and suddenly our P&L went from hundreds of millions.
What was the feeling like when you saw that?
At first, it was like the 5 stages of grief, kind of. It's like denial, then like bargaining. I don't know exactly what it is. But like, it isn't. No, whatever. It's not there. Then it was there the next day, and then it was like.
Do you know who it was? Is it one firm or multiple firms?
It was like a consortium of like CTC, Infinium, Optiver, DRW, and all these like Chicago shops that up until that point no one was really paying a lot of attention to. But they had basically figured how to automate my spreadsheet and put it into some super fast code and move the whole option surface around all day.
Wow.
Ultra liquid. Anyway, there was kind of this oh shit moment where it was like, wait a second, so we can't do the thing that we were doing that's just the easy free money anymore. That kind of made me realize, like, I don't have a lot of time left on this book. This book doesn't have a lot of edge other than basically overcharging people for risk that seems exotic until somebody else just kind of makes it pretty transparent. So with that bond trace ticker tape example in mind, I thought I need to seek out greener pastures. And when Vitol came knocking, it was a really, really appealing opportunity, not just because Vitol was a good name in the industry, and had been growing quickly, and it was sort of considered the most prestigious trading house to work for, but also because they offered me an opportunity to sit on the crude oil desk with the physical guys, really learn fundamentals, which I didn't understand at the time.
See it from the other side.
Yeah, and sort of swim upstream from those sort of oceans of transparency into the world of perhaps more opportunity and edge and learning, and maybe I'd have a chance to make a little bit of money doing something that most of the world wasn't aware of.
I remember, so I started 2013, and I think it was 2015 when you moved?
That's right.
So I remember it, like, the banks were pulling out more and more. And the big thing was, for big system traders who were able to take prop risk, directional risk at banks, suddenly couldn't because of Dodd-Frank rules. And suddenly it was just unglamorous. And I think the bonus restrictions as well, the best traders were moving to the majors and the trade houses, the BP Shells, the Vitols, the Glencores. So it was a steady. You saw people just. I guess you probably saw that as well. You saw the where
that's how it happened. I mean, the head of HR at Vitol is an extremely talented business person who used to work at Goldman as well. And when the Dodd-Frank stuff started to really hit the banks hard and
it was
margins
an easy
were compressing, he just literally rang up all the bank traders at any bank worth its salt and just had his pick.
Yeah, with the pitch being come and do exactly the same thing without the regulations, with possibly even bigger balance sheet in some respects. Maybe you could say that now. Yeah. But banks were pretty damn big in their time, right?
Yeah, I mean, I would say basically an attempt to recreate those sort of powerhouse derivatives operations that you saw at, JR and Goldman and Morgan Stanley in the kind of like glory sort of 2000s when China was starting to boom and you had that super cycle. Basically a lot of derivative talent and fortunes were made, inside of the banks. Like basically the trading houses had an opportunity to kind of recreate that.
So you had almost like a brain drain or whatever you want to call it. And then obviously there's plenty that happened at Vitol, but then the crypto move. So in 2021...
yes, end of 21.
End of 21. You then made the switch to, as the crypto market was booming, but actually almost becoming more of a Lehman Brothers with the FTX situation.
I didn't expect it. I mean...
I was sorry, I was just, the point there was then there was a brain drain there. There had been a brain drain there as well.
Yes.
That's kind of now coming back again because of it kind of coming to shit, I guess, whatever you want to call it.
Crypto is an interesting one. I mean, we could talk about it. I don't know how interested your viewers will be, but... at the end of 21, I'd been at Vitol almost 7 years, and crypto was sort of coming of age as a marketplace. What was so exciting about it at the time, and continues to excite me, is that it is a digital commodity. It looked familiar. I didn't really get it up until that point, but once the market became a little bit more robust, I realized, okay, so what is a commodities network? It's crude oil is just this decentralized world of fungible or semi-fungible hydrocarbons. In and of itself, it's not that particularly useful, but once you put it through a refinery, it becomes jet fuel and diesel and all the things that make the world go around. So basically, you have this physical network. You have producers and consumers of this thing. All over the world, there's sort of like kind of physical computation going on. If there's demand for crude oil in China, maybe that'll lift an economy in West Africa, right? And similarly with crypto, in and of itself, a Bitcoin or 1 unit of ETH isn't particularly useful to anybody. But if you refine it, i.e. you buy it or you mine it and then you spend a little bit of it as gas, effectively, there's some losses in crypto too, then suddenly you can turn it into interest-bearing products, certificates of authenticity called NFTs, and all these little digital goods and services that'll fuel the online world where society is increasingly spending, the vast majority of its time, like it or not. So the digital commodities world sort of made sense to me, and the volatility is actually pretty similar. 30 to 50% in crude oil, maybe 50-60% in natural gas, and crypto somewhere between 30 and 80% these days. Like it's like just the prices move a similar amount per day, per year. And so, I kind of got my head around it. Also, the volumes were pretty massive too. So it started to look like a real marketplace. I didn't expect the implosion that followed, but I figured prices would probably come off from their frothy highs, but I didn't expect the second biggest exchange to be a scam. I didn't expect that was the big one, really. I
mean, the way I'm looking at it, and I was going to ask you on this, is it feels like a cycle of any market to some degree. Obviously, it's had its drama, but you need to kind of shake the system, see what it can handle, break it, and then if the long-term solution is there, it will figure itself out. And that's kind of what's happened. I mean, a lot more structure now. ETFs are now coming into play. Like this feels like how it should be. I mean, it was just unregulated because it was so new and people were trying to catch up. But this is what happens, right?
Nothing in crypto, no blockchain actually broke during that whole insane cycle of 2022. It was just like how economics work without a central bank or without an OPEC, right? Prices literally just extend to force maximum pain to centralized entities that have mismanaged their books, like FTX.
But I don't think exactly. There's nothing wrong with the price move.
Yeah.
It was to do with the infrastructure around it, and then now we're going to be building new infrastructure, and it will be the market will be better for it. I mean, the oil market 20 years ago looks very fucking different from what we are now,
yeah.
right? So
I mean, oil and crypto are pretty much the same thing. Like 150 years ago, oil was early stage technology, and it was tradable. It was this black tar that came out of the ground in Pennsylvania. You know, people would use it to glue together canoes and not much else, right? But it had a price, and there were boom and bust cycles. You could read The Prize by Daniel Yergin, I'm sure you have, and you know, it's basically the same as blockchains now. It's like, hey, what is this early stage technology? Why does it matter? Is it the future? Is it a total scam? You see the same, you know, it's early stage technology that's tradable. It's not like Uber stock before it goes public, where the price isn't really like ticking around on a screen. It's in some venture capitalist's portfolio. It's early stage technology, and it's tradable, just like oil was at one point, and kind of just like LNG is now. But just to wrap this thought up, you know, anybody who's worked at a Vitol or a Traf or a big hedge fund, a big physical trading company, will have seen what it takes to move raw material or raw hydrocarbons from between two economies that don't necessarily talk to one another, right? Like, you know, the famous Mark Rich trade was selling Iranian oil to Israel. And at the end of the day, what we're seeing geopolitically right now are these sort of Orwellian hemispheres getting erected between East and West. You have like the China-Russia hemisphere, you have the US, EU, NATO hemisphere. They're going to need to trade a lot of commodities with each other, but maybe the dollar isn't necessarily the best denominator for those transactions going forward, particularly given how it's been weaponized as of late. And I do believe that, you know, maybe not 100% of global commerce, but maybe something like 1% of it will be denominated in cryptocurrency one day. I don't think that's an insane, outlandish statement. And I think if that occurs, you know, the price of Bitcoin is going to be $1 million a token.
I was going to say, this is going to sound stupid then, given what you just said, but why does the price have to be high if everyone's using it?
Because they can't print more of it. And so if more people want to use it, then more people have to buy it, right?
But ultimately, all the producers could just of the coin could be selling it, right? Ultimately,
miners,
and miners, and that kind of arbitrages out at some point. So you have these natural, I get it, like step changes because of the supply and demand of the coin. But
effectively, the way the demand for any commodity, including Bitcoin, works is you just sort of have to look at the use cases for that commodity. Ask yourself how much of this commodity has to be held on balance sheet in order to facilitate these use cases. And it's really just that sort of two-step process to determine the global amount of demand for something at a root level. Obviously, working that out in real life is impossible. But right now, if you think that Bitcoin has one or two use cases, which are sort of effectively speculation and maybe wealth preservation in economies where other currencies aren't necessarily available. You know, if you're an Argentinian or a Lebanese person.
But is it really that simple? I guess if you look at even the sterling versus the dollar versus other currencies, it was like $3 like in the 80s, something crazy, or $2.80 to the dollar.
Well, Bank of England could just show up and print another trillion of it, right?
Yeah, no, I'm just saying, as in like, because everyone it was the global currency. So what do you call it again? The
global reserve currency.
The reserve currency. Whilst it was an empire, and the price did go higher relative to other currencies, and then the dollar did it. So it's more, you keep saying it's a commodity, but then that feels like more of a currency argument, is what I'm saying.
Yeah, it's possible. I mean, put it this way: if your current use cases for Bitcoin are speculation and perhaps wealth preservation, and then you add a new use case, which is denominator for global trade or certain types of global trade, then suddenly nation states have to hold some on balance sheet to pay for cargoes, right? Or, you know, hold some on balance sheet because they need a wallet to receive Bitcoin in exchange for selling a cargo.
Yeah, I can see when you break it like that, it's so obvious to the believers that it's just a buy.
To me, it's the most obvious trend of my lifetime.
Well, but I have to ask, because whenever it's just going to go up, it's like, you don't get a hell of a lot of great reasons for, other than like, it just should, because of the trends and because of what the people buy. But mostly people just say because more speculators are going to get involved. So therefore the price is going to get high, which I get, but that's just trading a herd market, which is dangerous. And
that can blow up in your face, as we saw in 2022.
Yeah.
I think from first principles, I think that Bitcoin will ultimately be an alternative global reserve currency that captures more than 1% of global trade by the time I'm
So everyone's going to have to
50.
buy it to store it to be able to trade.
Yeah.
So therefore the price is going to go high because there's not enough production.
And the other thesis would be, I think that it will replace money in, let's call it the world's, it'll replace the world's bottom 50 fiat currencies. Would you rather hold the local currency in Chad if you live in Chad, or would you rather hold, a fraction of a Bitcoin?
So anyway. I know it might be a stupid question, but I think it's important to talk first principles to really, as you say, that you took a point about writing things down.
Yeah.
I couldn't agree more. And like, again, that's why I always want to challenge people's beliefs on how markets move, in the oil market in particular, because people say blind things like it should go up because this, and if you challenge it, you don't know what you're talking about. But if you can go to first principles and discuss it, then you do know what you're talking about. It's kind of my point. So I always like to kind of go layer to layer. So we've had this debate. We're going to continue having this debate about oil, I'm sure.
No, thank you for asking. It made me question. Yeah. I appreciate it.
So, probably as expected, went on a bit of a tangent there. But I guess if we get it back to, using this experience and such an invaluable experience from seeing booms and busts in different kind of, not just markets, but infrastructure, banks to then trade houses to, brand new like
high frequency prop shops.
It's fascinating how markets develop.
Yeah.
But I guess we have to focus on financial markets? I suppose so for now, right? In the terms of like what's Onyx doing and what you're doing here. So, I loved your profile because at the end of the day, I knew that we had great operations in all our individual oil product desks, gasoline, the naphtha, crude, all doing very well. But you're getting to a certain size and a certain market share of the overall oil market that there's inefficiencies, even though ironically we're the ones eroding the inefficiency in the market. We're in ourselves being inefficient. So you've got to look at this experience of where markets do go and what liquidity providers do and kind of unravel what we're doing a little bit, use the collective dominance of our market share and basically optimize that. So that's obviously the first thing. That's why I think you can bring a lot of value to us, and you already have, of course. But in the long run, you're in line with our mission, right? We want to basically see, even though we're in a very developed market and it's not like crypto that's on this long-term boom, there's still, I think, a lot of work to be done to democratize it. And people don't love that word. I've realized by the PR company is saying it's too much on the tongue. I'm like, but it's just it's the best way to say it. It's leveling the playing field, let's say. And what does that really mean? It frustrates me that people can't trade our market because all we do is trade futures, and yet you don't have access to them really if you're an institutional investor or if you're a retail investor. So that is a big project for us to give access to people to trade. But then that's just one of the things. So maybe you could talk a bit about how you see the market going in oil in particular, kind of, I guess, the OTC to more digital type stuff as one thing, but also just wider how you see it.
Yeah. Well, first of all, thank you for bringing me on. I didn't know, I'd always heard of Onyx because the name came up a lot when I was at Vitol, but I didn't know very much about what you guys were actually doing until you explained it to me. And once you sort of basically laid out your vision, it became kind of obvious that I wanted to work here. It was a very, very exciting mission, which is to sort of shine a light on the commodities space and basically tighten it up a little bit, democratize it for everybody, and make the end user, who is ultimately 8 billion people out there, a little bit wealthier, a little bit happier. And so what I saw in my background that I thought would fit in here, like any speculative career move, you never know. But what I saw was that Onyx kind of has this platform where I could put together a lot of the fundamental things that I learned at Vitol with a lot of the technical and systematic stuff that I picked up, in my last place at DRW, attempt to sort of put it all together to provide, ultimately help Onyx tighten up liquidity in some of these more niche, shadowy parts of the oil market that are only niche because there isn't liquidity, right? Let's say that airlines are hedging jet fuel or some chemical producer is trading naphtha. if they're doing it, they're ultimately getting a kind of a terrible price. For most of my oil career, talking to Goldman, getting ripped off, or trading on something that's super inefficient. So often these companies would just trade Brent or WTI instead, and have this largely decorrelated, ineffective hedge, which at the end of the day is a cost for them that gets passed on to the end user, which is you and me, or the guy out on the street. So what I see at Onyx is this opportunity to provide kind of like liquidity as a service, liquidity in a box, and plug it into institutions and plug it into retail, and create this sort of amazing flywheel effect where everybody can suddenly trade what matters to them, as opposed to just the thing that's liquid that's sort of what matters to them, WTI or Brent. Now, the way that you pitched it to me, and the way that I'm kind of tackling it here, which hopefully we can build upon as time goes on, is optimization internally leads to better liquidity. And also when you adhere to systematic processes, when you effectively say, why am I making money? Would it work outside of these walls that I sit within all day, right? You have to build a system or a machine that can do at least some or possibly most of what you do. And once you're capable of doing that, then that frees up, the 80 or 90% of your mental bandwidth that you would have been spent just running your thing to pursue even higher intellectual profit adventures that ultimately lead to more liquidity, more money for Onyx. And actually, when a market maker attracts more volume, that means that everybody they trade with is making more money, right? That means they've tightened up a market. That means they've revolutionized something. Sometimes it's a regulatory feature that unlocks that, like Trace. Other times it's literally just a CTC or Infinium or Optiver building some tech that takes a market from 2-bit at 25 on smalls to 1-bit at 3 on infinite size, and that real innovation actually makes everybody better off. The options volumes have exploded since that happened, and Onyx can do the same for the entire product and pet chem complex. It's pretty interesting.
We've got to be clear how we think that jump then goes to the end user and to everyone. And I think, do you remember we were saying, so someone wants to hedge, someone wants to buy or sell the oil ultimately. They might use derivatives, but actually they're probably most likely just going to be using derivatives as a benchmark to be able to price their crude or their product. So visibility is a massive thing. So there's a lot of people who will benefit, maybe more people who will benefit just from the liquidity providing transparency and that data being useful. Because if they can then say, no, I 100% know where the price is, so no one's playing any games with me because I know exactly where it is. So if you want to add a margin on it, I need to know why. Well, it's because I'm giving you access to the market. I'm giving you credit. Okay, fine. And people can get more on board with that. But it's certainly going to be at least, I think people prefer to know. People don't mind paying. They want to know how much they're paying and kind of why. And then you got to accept it because it's like, well, what else are you going to do? But they don't like to be paying over the odds. I always remember, I had a massage in the Four Seasons once. I was like, do you know what? I'm going to go all out. I'm just going to have a massage. I'm on holiday. And I was like, hour massage, whatever the cost is done. They went, okay, £1,500. And I was just like, I was expecting a premium, but that is gold plated. This is a joke.
What was it awesome?
No, it was average. This is what I'm saying. So it's like you've just taken the market access to massage because I'm in the middle of an island, and it's the classic thing. So that annoyed me. It just didn't need to happen.
Yeah.
Anyway, so that's one thing. But I think you could still query it and say, well, what am I going to do? The people I trade with is a captive market, effectively, right? I have to take their bid offer. But the hope is, if you know exactly where the real price is and you know what you're being charged, it encourages competition. So the next person says, I can offer you a bit better, and then it keeps going down. That's how markets always work. That's fair to say, right? And that's always how it's going to be. Mm-hmm. One thing that's amazing to me is just how liquid it can get. And this is the bit where I exhausted my knowledge, understanding, and the way I could look at it was, if I make the tightest of bid offers I can, and then someone still beats that, and they're a market maker, I'm like, what the hell is going on? And that is the next journey where you get to a complexity that actually you're effectively taking on flow at value because you've got a clever way to distribute it. And that might be because you have this fantastic network effect of multiple different desks and you've got all these different ways to hedge it. Or it could be like the retail brokers do. They literally take the other side because they expect retail guys to lose money. But if you don't want the guys to lose money and you're advising them and all that, how you go about being that tight is so interesting.
But a lot of science involved. You know,
a lot of science involved. Yeah.
At DRW, for example, you know, in order to show the tightest price on Bitcoin, which is pretty liquid, you have to know what the price of Bitcoin is going to be in 10 seconds with some degree of probabilistic confidence. Like, you're not even able to show mid-market and put together a bunch of other pieces of the puzzle to make a profit somehow on your mid-market basically choice price on Bitcoin. Like, you literally are arbing the present versus the future. That's the only way to add value, because it's so liquid and so tight. So doing that in real time, it just involves a tremendous amount of computation, armies of quants. It's
and it feels like that's where markets always end up.
That is,
and it's just yet to happen in this market. And I think when I say this market, Brent and WTI and the classic futures, probably they are that. But then you've got, as I say, the 700 futures that are mostly OTC traded, as in voice traded via brokers. And I mean, it's just crazy that it still exists, but it's just the way the market has kind of infrastructure's played out. So that's very likely to evolve in the next 5 to 10 years. So I guess a bit more about the market. I mean, you are ultimately still a trader as well. You have systematic strategies and obviously have a great outlook of the overall market and the economy. What do you think this year, the headwinds, some of the volatility that could come up, and why?
So consensus right now is volatility is going to zero. Why? Because you have OPEC throwing their weight behind this massive cut. Well, it's really just Saudi Arabia, as always. And so there's a ton of work being done on the physical side to defend current price levels, but then if you can't really see too much of an explosive rally either, even on some of this geopolitical craziness, there's all this oil waiting in the wings just to get flushed into any deficit. So I think a lot of people are feeling a little bit of, active traders are feeling a sense of despair about flat price. Not a lot of volatility, not a lot of money-making opportunities. And you look at the candlesticks so far this January, it doesn't, you just looking at a chart without a name on it, you wouldn't know it was oil. You would think it was like milk futures or something. It's really...
This milk futures pretty stable.
It's like, it looks like it doesn't trade, cheese maybe. Something that doesn't move that much or that doesn't have a lot of interest.
Did you hear the French pour away like 100 million? The government buy 100 million worth or something, or 200 million euros worth of Bordeaux type wines, like fine wines, throw it away to keep the price elevated and protect their producers.
Bastards.
So it's quite. It could be
so
cheese
French.
Could be very volatile.
You never know.
Yeah.
Make a wine future here in
exactly.
Onyx.
Easily. They already exist, I think.
Really?
Yeah.
Well, oil's trading like it if it exists, because it just locked in this $5 range. So I think the consensus is that we're not going to see any volatility. The implied daily move is about $1.60 a day. That's what options are telling you. Brent is going to move every day, and to me, that's kind of high versus most of my career, but also sort of meh, like no real volatility trade. However, consensus tends to be wrong, right? I think you got a couple potential shocks to the system coming up. One is that Saudi Arabia could just say enough of this. I don't think they will, but if they give up on their cuts, like we're headed straight to $40 a barrel. It's going to get really ugly before things recover. The reason why I don't think they'll do that is because, unlike the 2014 market share war, they're not going to be fighting small companies that are undercapitalized. They're fighting Exxon. They're fighting these giant IOCs and NOCs that can weather quite a lot. To the upside, it's hard to see anything other than an all-out war with Iran or a shutting of the Strait of Hormuz, or maybe another like Abqaiq thing, like another missile takes out a Saudi missile from air quotes Yemen, but really Iran takes out something important. But like ultimately, I think the big wild card is this year's election in the U.S. I think that it's looking like another rematch between Biden and Trump, but one of them could go to jail. Both of them could just die. I mean, look at them. These guys are not young, right? So,
is it like in terms of bringing it back to economy and then oil? Like, what is the real volatility around the decision making? I mean, is there that much of a dissociation between the policies in oil, for example?
Yeah. So, Republicans, they tend to be the drill baby drill crowd, right? Yeah. They're gonna unlock the floodgates and go for energy independence. You could see crazy sort of libertarian policies like an export ban come back. That would really screw with the global oil markets. You could see, I'm not calling for this, but it's a possibility if you have a wild card come into the U.S. election. Equally, you could have some sort of like Democratic Party orchestrated transition of party leadership in an undemocratic way from, say, Joe Biden to California Governor Gavin Newsom, who, having lived in California, I can state firsthand that he is about as anti-petroleum as it gets. I can see him easily just doing things that absolutely tear up the oil industry. I think that would be tremendously bullish for flat price if he just gutted the American oil industry. And this isn't insanity to talk about this.
Fair enough.
It's being discussed openly in Washington now. These types of things. So
maybe a good trade is, there is the flat price volatility, but WTI versus Brent, right? It's always been a diff, the highly traded, highly liquid differential.
Yeah.
But so much more important now that WTI settles Brent. So it's just really just an arbitrage, a genuine arbitrage differential. So it sounds like we want to kind of be bearish volatility on flat price at the moment, but you could actually be buying volatility in WTI Brent.
Yeah, that's a great point. It's a
CSOs.
It's like they're called ARB options. You can trade them on WTI Brent. They're fairly liquid. I think you just trade the ARB because the ARB is an option at this point, right? Like if you were going to bet that on a 2% chance of an export ban coming back, it was lifted 8 years ago or something. But if you're going to bet the export ban comes back, right, you could just sell ARBs. And if you're wrong, like you don't really lose any money. The ARB doesn't move anymore because of this really well sort of created fungible system between WTI and Brent. But if that were to stop, then suddenly you reap all the upside. So the ARB is an option at this point. You don't need to trade ARB options.
Interesting. Jonah, thanks a lot for this. I think it's really, really exciting what we're embarking on together and as a business, and you're going to be right there in the thick of it, and obviously I hope you enjoy it a lot, and thanks for taking the time to talk on this podcast.
Thank you for having me. I already am having fun. It's great.
Maybe not your 20,000 views yet on the podcast, but maybe one day, maybe when we're in retail, but this maybe could help. So any viewers that usually listen to Jonah, I hope slight pivot was interesting if you're listening to this for him. But we'll leave it there, and the audience, thank you very much for listening as always, and we'll be back next week for another market episode, and we'll see you then.